Imagine sitting at your desk, looking at this massive proposal to build a custom piece of software for your business, and you're about to sign a check for, like, $500,000.
Which is terrifying.
Right, it is. But you take that financial hit because, well, off-the-shelf solutions are just suffocating your growth. You expect this absolute Ferrari of a system.
Yeah, exactly.
But what if I told you that by simply planning and, documenting that build correctly from day one, the Australian government would have basically handed you a 43.5% cash refund on the hardest parts of that project?
A lot of people just don't realize that.
They don't. You are likely leaving massive money on the table right now. So, welcome to this deep dive, especially to the loyal followers of the C9 business page who join us to, stay ahead of the curve.
Absolutely.
I'm your host, Lex.
And I'm Vera, your resident expert here at the C9 Podcast Show.
And if you are an Australian business owner or a C-level executive, we are talking directly to you today. The mission here is to unpack the 2026 R&D Tax Incentive.
We really need to separate fact from fiction on this one.
Yes, exactly. We want to show you the mechanical reality of how to turn the government into a literal co-investor in your tech innovation.
And, just as importantly, how to bulletproof yourself against the ATO so you can actually claim what you deserve without the stress.
Because, let's be real, the landscape for businesses in 2026 it's incredibly unforgiving.
Oh, it's brutal. Operational costs are just bleeding margins dry left and right.
Yeah.
And these legacy systems businesses use, they're acting like an anchor on productivity. But when companies finally, bite the bullet and commission custom development.
Like a bespoke app or a complex database integration or something.
Exactly. They just treat the cost as this massive sunk penalty. They completely ignore the financial mechanisms that are literally designed to subsidize that exact type of risk-taking.
Which means we really need to talk about the actual scale of the financial relief that's available to SMEs right now.
We do.
Because, we constantly hear these vague numbers thrown around about tax breaks. Let's ground this for the business owners listening. What is the actual lifeline on offer here?
Well, the baseline numbers for the 2026 financial year are staggering. If you meet the criteria, obviously.
Right.
So the R&D Tax Incentive is jointly administered by the ATO and the Department of Industry, Science and Resources.
Okay.
And if your business is an Australian incorporated company, so not a sole trader, not a partnership, and not a trust, and you have an aggregated turnover of under $20 million.
Which covers a lot of SMEs.
Most of them, yeah. You are potentially looking at a 43.5% refundable tax offset.
43.5%. That is a highly specific and, frankly, a massive chunk of change.
It's huge.
How does the tax code even arrive at that exact figure? Because it doesn't sound like, a standard deduction.
No, it's not a standard deduction at all. It's a tiered offset.
Okay, how does that work?
The mechanism basically works by taking your standard company tax rate, which is typically 25% for entities in this turnover bracket.
Right.
And then it adds an 18.5% premium directly on top of that.
Oh, wow. Okay.
Yeah. Now, the baseline requirement is that your minimum eligible expenditure on the actual experimental work has to be at least $20,000.
So you can't just claim a $500 website tweak?
Exactly. The only way around that $20,000 floor is if you outsource the work to a registered research service provider.
Makes sense. And is there a cap?
Oh, on the extreme upper end, a company can claim up to $150 million in a single year.
Okay, $150 million is a staggering ceiling. But for the executives listening right now who are budgeting, say, $100,000 or $200,000 for a critical inventory system integration.
Yeah, more typical scenario.
Exactly. How does this offset actually hit their bottom line? Especially if, they are a startup or a business that's pouring all their revenue back into growth and they're operating at a loss.
Right.
Does a tax offset even matter if you technically owe zero tax?
Yes. And that is genuinely the single most powerful mechanism of this entire program.
Really?
Yes, because it is a refundable tax offset.
Wait, refundable?
Refundable.
Yeah.
So if your company's in a loss position, the tax office doesn't just, give you a credit for some distant profitable year in the future.
Okay.
The excess over your tax liability is calculated and paid out directly to your bank account as a cash refund.
So they literally write you a check.
They literally wire the money.
Yeah.
It functions as a cash injection back into the business, rewarding you for taking the financial risk of attempting the innovation in the first place.
Hold on, I need to push back on this a bit because I feel like there's a massive disconnect between the terminology and the reality of modern business here.
How so?
Well, when anyone hears the phrase research and development, the brain immediately goes to, like, scientists in sterile laboratories, right?
Test tubes and lab coats.
Exactly. We picture pharmaceutical trials, chemical engineering, maybe aerospace stuff. A logistics firm trying to build an app to route delivery trucks just doesn't feel like R&D.
Right.
So is this program actually intended for regular businesses building commercial software?
The data destroys that misconception entirely, actually.
Does it?
Completely.
Yeah.
If we look at the official ATO statistics from the 2022 to 2023 review period, the reality of who gets this money is crystal clear.
Okay, hit me with the numbers.
In that window, 12,956 companies claimed a total of $16.2 billion in R&D expenditure.
$16.2 billion.
Wow.
Yeah. And a massive 44% of those claims came from the professional, scientific, and technical services sector.
Let me guess. That includes software.
Heavily dominated by software development and systems engineering. Furthermore, small businesses made up 46% of all claimants.
Okay, so this is definitely for everyday businesses.
Exactly. The government recognizes that the modern frontier of efficiency and, competitive advantage isn't happening in physical laboratories anymore. It's happening in code bases. Wait, but if $16.2 billion is flowing out the door, the ATO isn't just handing that out on the honor system, surely.
Oh, absolutely not.
There has to be a severe filter. Like, if almost half the claims are coming from tech and software, how do they distinguish between a business just building a standard e-commerce app and a business actually doing R&D?
That's the million-dollar question.
Because every developer I know claims their project is incredibly difficult and complex.
Right. But difficulty does not equal technical uncertainty.
Okay.
That is the fundamental concept every C-level executive needs to understand to avoid a rejected claim. The ATO separates development into two strict categories.
Which are?
Core R&D activity and supporting R&D activity. And the filter they use to categorize your project is called the technical uncertainty test.
Technical uncertainty test. How does that actually work in practice?
The acid test is basically this. Before you wrote a single line of code, could a competent professional in the software engineering field look at your problem and know, based on current publicly available knowledge, that your proposed solution would work?
Okay.
If they could predict the outcome, it is not core R&D.
Let me make sure I'm translating this to the real world properly.
Go for it.
Every time a development team builds a custom integration for, say, Shopify, or they plug into a standard accounting API like Xero, they complain it takes weeks of hard work.
Oh, always.
But what you're saying is, even if it takes 1,000 hours of grinding through terrible documentation, the end result is never technically in doubt.
Exactly.
It's just a matter of effort. It's not an actual experiment.
That distinction is vital. Effort is entirely irrelevant to the ATO.
Interesting.
Routine bug fixes,
Yeah.
standard API integrations using known endpoints, cosmetic user interface design, data migrations.
None of that counts.
Nope, these are explicitly excluded from being core R&D. You are just applying existing knowledge.
So what does count as core?
Core R&D requires that you are attempting to generate entirely new knowledge, like a new algorithm or a novel architecture. And you must be taking a systematic approach to prove a hypothesis where the outcome is genuinely unknown.
Let's put an analogy on this to really expose the mechanics here.
I got a good analogy.
Okay, so building a standard Shopify integration is basically like assembling IKEA furniture.
Yes.
It might take you all weekend, you might use the wrong screws and have to start over, and it's definitely a frustrating amount of effort.
We've all been there.
Right. But you have the manual, you have the parts, and the outcome is entirely predictable. An IKEA desk will always eventually be an IKEA desk.
That captures the lack of uncertainty perfectly. There is no new knowledge generated in assembling that desk, no matter how many times you drop the Allen key.
But core R&D, that is more like trying to invent an entirely new type of weight-bearing wood to hold up a skyscraper, right? Because steel is too heavy or something.
Yeah, that works.
You have a chemical theory about how to bind the wood fibers, but you genuinely do not know if that new wood is going to snap under the pressure of 50 stories until you actually put it in a press and test it to failure.
Let's expand that analogy directly into the technical reality of software, because that's where the money actually is.
Okay, how does that look?
So the IKEA build is your standard database migration. The new weight-bearing wood is attempting to build a, let's say, a novel machine learning model to process live, unstructured data feeds from thousands of IoT sensors on a factory floor.
Oh, wow. Yeah, that's complex.
Very. In that scenario, you have a theory about how your algorithm will handle the asynchronous data flows, but you don't actually know if this system will experience race conditions.
Right.
You don't know if the algorithm will hallucinate or suffer from catastrophic latency under a specific server load. The uncertainty is intrinsic to the technology itself.
Not just the developer skill level.
Exactly. Attempting to solve that specific technical unknown through systematic testing, that is, core R&D.
And what about the other category? You mentioned supporting R&D earlier.
Yeah, supporting R&D activity covers the necessary tasks that are directly related to that core experiment.
So things you have to build just to run the test.
Exactly. So if you need to build a basic user interface specifically so your engineers can feed test data into that experimental machine learning model,
Okay.
then the work to build that specific UI could be claimed as a supporting activity. But it absolutely must have a direct causal link to the core experiment.
Okay, got it. Because the payouts are so high, and because the line between hard work and core R&D can seem pretty blurry to an untrained eye, I imagine the ATO is naturally cracking down on this.
So heavily.
Yeah, the word on the street for 2026 is that audits are just brutal right now.
The compliance environment right now is the strictest we have ever seen, hands down. The ATO and AusIndustry are actively hunting for specific red flags.
What's the biggest one?
The most common pitfall, the one that triggers immediate audits, is overallocation.
Meaning claiming too much time.
Yeah, a business will try to claim 100% of a senior developer's salary under the incentive, completely ignoring the fact that the developer spent like 80% of their year doing routine maintenance.
And maybe only 20% actually running the core experiment.
Exactly. Another massive red flag is weak cost linkages.
Cost linkages.
Yeah, if you cannot prove with a paper trail exactly which dollar paid for the experimental work versus the routine work, your entire claim will be dismantled.
I understand there is a new compliance hurdle arriving shortly that makes this even more intensive for the person actually writing the claim.
There is. In August 2025, a new AusIndustry form rolls out, and it radically changes the level of detail required.
How bad is it?
Well, businesses are now expected to provide up to 4,000 characters of text just to describe the core activities.
Oh, wow. You can't just write, "We built an app."
Definitely not.
Mm-hmm.
The form explicitly demands a highly detailed breakdown of your technical hypothesis, the specific variables you tested, and concrete documentary evidence proving the uncertainty existed before you started.
Okay, that brings up a terrifying scenario for a lot of startups.
I can guess what it is.
A lot of businesses operate fast and break things, right? They just start coding.
Yeah, they do.
A year later, the CFO looks at the massive server bills and developer costs and says, hey, we should claim this under the R&D incentive.
Happens all the time.
Can a business look backward, realize the project was full of technical uncertainty, and basically write the hypothesis retroactively to get the tax break?
No. Doing that is the absolute fastest way to get audited and penalized.
Really?
You absolutely cannot reverse engineer an R&D claim just because a project went over budget or was harder than expected. The ATO operates on a strict requirement for contemporaneous records.
Meaning records that are physically created during the time the experiment is actually taking place.
Yeah, not a summary written 12 months later.
Okay, let's look at the mechanics of an audit to understand why that matters so much.
Sure. So if an ATO auditor walks into your business, they are going to ask for your JIRA tickets, your GitHub commit logs, your Slack channels.
Yeah. They read the Slack channels.
They absolutely can. And if your formal technical hypothesis document is dated, say, June 2026, but the GitHub commit logs show your developers were already actively testing the code in February 2026.
You fail the audit.
You fail immediately. You have to prove the uncertainty existed before the work commenced.
So what kind of documentation actually satisfies them, practically speaking? I mean, a C-suite exec isn't the one writing code commits.
Right. You need a system that captures the scientific method in real time.
Like a proper lab notebook, but for code.
Exactly. You need a formal document stating, we hypothesize that applying algorithm X to dataset Y will reduce latency by Z, which is currently technically unknown.
Okay.
And then you need timesheets mapped directly to that specific experiment. You need to save the architecture diagrams. And crucially, You need to document your failures.
Wait, document the failures. Most development teams try to hide the code that didn't work
I know, but from an R&D perspective, failure is gold.
because it proves it was hard.
It proves genuine technical uncertainty existed. A log showing that a server crashed, or an API timed out under load, that's your proof. If everything works perfectly on the first try, the ATO will just argue there was no uncertainty to begin with.
That makes total sense when you frame it like that.
Right. And you also need clear cost allocation trails, like contracts and invoices that clearly define the experimental scope of work.
Okay, I have to be honest. This sounds like a compliance nightmare that might scare people away from even trying to claim it.
It can be daunting.
But the goal here isn't to induce panic. The goal is to show business owners how to navigate this maze so they can actually get the funding they deserve.
Absolutely.
So let's make this highly practical. Walk us through a tangible example of how a business can legally maximize their return without triggering an audit.
Okay, let's do it.
Because I assume you don't have to force an entire software build into the core R&D box to get a benefit, right?
You don't, and honestly, you shouldn't even try to. The smartest businesses use a method called strategic stacking.
Strategic stacking.
Now, the baseline legal rule here is found in Section 355-205 of the Income Tax Assessment Act 1997.
Catchy name.
Very. And it strictly prohibits double dipping.
Meaning the government will not let you claim the exact same dollar under two different tax relief programs.
Correct. But a software project is not one giant indivisible dollar. You can carve up the invoice based on the nature of the specific tasks.
Okay, let's look at the mechanics of this. Let's say we have a $60,000 bespoke manufacturing software project.
Great example.
Let's slice the pie. We have a 60 grand total spend. How do we structure this practically?
First, we isolate the infrastructure. Let's say $18,000 of that project goes toward setting up cloud servers and baseline database frameworks.
Okay.
That is standard, predictable capital expenditure.
Yeah.
You take that $18,000 and claim it via the instant asset write-off, the IAWO.
Which gives the business an immediate tax deduction for the purchase of those assets. Okay, the servers are covered. What about the user interface, like building the actual dashboard that the factory workers look at?
Let's allocate $12,000 to building that standard UI and connecting it to existing off-the-shelf software APIs.
Right.
As we established with the IKEA analogy earlier, there is no technical uncertainty there. So that $12,000 is claimed simply as a general business operating deduction.
Got it. Which leaves $30,000 remaining from our original $60,000 budget.
Yes. And that final $30,000 is walled off entirely for the experimental work.
The core R&D.
Exactly. That money is dedicated to developing the novel machine vision algorithms, like the system trying to detect microfractures on a fast-moving assembly line, where that specific real-time processing speed has never been achieved before.
Which is incredibly hard.
Right. That is pure core R&D. So you claim that $30,000 under the R&D tax incentive.
Okay, and the math on that.
Applying the 43.5% effective rate, that specific portion of the spend yields an approximate cash benefit of $13,050.
See, that is the aha moment right there. I really want to emphasize how this actually executes in the real world, because you can't just make these divisions up at the end of the financial year.
No, you definitely can't.
If I'm the business owner, I need to ensure my developer isn't just sending me one generic invoice that says software build dash $60,000, right?
That is the critical point of failure for most SMEs. To execute strategic stacking legally, the separation has to exist in your commercial paperwork from day one.
It has to be baked in.
Exactly. Your statement of work needs distinct phases. Your developer needs to issue separate line items on their invoices.
Like phase 1 is infrastructure, phase 2 is UI.
And phase 3 is machine vision algorithm experimentation. When the ATO auditor looks at your books, the financial trail perfectly matches the technical categorization.
That is so smart.
By structuring it strategically, you lower the net cost of the total project, boost your ROI, and stay entirely compliant.
This just requires a total shift in perspective for C-level executives. I mean, off-the-shelf software solutions might seem safer initially, but they inherently limit your operational growth.
They absolutely do.
But when you embrace custom software and actually structure the investment legally and systematically, those sunk costs transform into powerful government-subsidized drivers of competitive advantage.
And the window to act on this is rapidly closing.
Right, deadlines.
For companies operating on a standard financial year ending June 30th, 2026, the hard deadline to register your activities with AusIndustry is April 30, 2027.
Okay.
However, As we've exhaustively covered today, you cannot wait until 2027 to think about this. The contemporaneous records the JIRA logs, the hypothesis documents, the invoices. They must be generated right now actively while the FY26 development is taking place.
Which means the most vital decision you will make isn't just deciding to build the software, it's deciding who builds it with you. If you want to assess a project's potential before the end of financial year 2026, you cannot do this alone. And you certainly cannot do it with a development agency that treats compliance as an afterthought.
You really can't.
You need a partner who builds with foresight. You need engineers who integrate hypothesis-driven development and rigorous logging directly into their daily sprints. Basically, you need to contact C9.
Absolutely.
They are Australia's leading custom software, apps integration, and database developer company.
And they understand this stuff inside out.
Yeah, C9 doesn't just hand you a piece of code and walk away. They collaborate with you to align your technology roadmap with these strategic financial mechanisms. That ensures that when the work qualifies, your entire paper trail is completely audit ready.
It's just peace of mind.
Exactly. Do not leave this to chance. Visit their website today at www.c9.com.au. Again, that is www.c9.com.au.
It really cannot be overstated. Having a reliable partner who fluently speaks both the language of highly complex technical delivery and the rigorous language of ATO documentation is the only shield you have against the heightened compliance scrutiny of 2026.
I completely agree. If you found value in this breakdown, please hit that follow button wherever you are listening right now.
Please do.
And more importantly, if you know other Australian business owners, founders, or C-level executives who are just burning capital on custom tech and potentially leaving massive legitimate tax refunds sitting on the table, share this audio session with them. Getting this right literally changes the entire financial trajectory of a tech build.
Before we wrap up, I want to leave you with one final sobering reality to process.
Lay it on us.
Think about your legacy systems right now. Every single day you delay modernizing your operations because you are paralyzed by the upfront cost of custom development. Your competitors might be taking that exact same leap.
Wow.
Yeah. But if they have structured their projects correctly, they are upgrading their capabilities at a 43.5% discount, directly subsidized by the government.
That is a massive advantage.
It is. So look at your market position and ask yourself, by waiting to innovate, are you actually saving your company money, or are you just actively subsidizing your competition's lead?